If you received $250,000 today, how would you invest it into the market? All at once or over time? When it comes to placing money into the market, there's a lot of myths and misunderstandings. So today we will unpack dollar cost averaging versus lump sum, which is better, which has the better math, the psychology behind them all. Let's chop. When it comes to investing into the market, people have a common question. Should I put a little bit in over time or dump it all in? And that's the difference between lump sum investing and dollar cost averaging. What do they really mean? Lots of misunderstanding and, misinformation out there about these two techniques. What are the pros? What are the cons? What's the psychological benefit? What's the math? Which one is better? So we're going to chop up and talk about those lump sum and dollar cost averaging today. Hi, I'm Dr. Preston Cherry, founder and CEO of Concurrent Wealth Management, where we help you align your life and money to help you live your wealth your way. And if you like what you see, hear, and feel on the show, subscribe to the show so you don't miss an episode. All right, let's chop. What is this lump sum investing and dollar cost averaging investing? What's it all about? And what does it have to do with how you go about investing your money? It's a common question, and folks tend to have different behavioral aspects to placing all their money into the market or spreading it out across time. Now, there's two definitions that we're going to unpack, and actually three, because there's lump sum investing, there's dollar cost averaging. Well, what do you mean by that, Dr. Cherry? Well, let's unpack the dollar cost averaging. All right. The two definitions are, well, one is if you received a lump sum of money right now and you were to not dump all that money into the market at once, what you would do is, for example, if you received $250,000 right now, you would place 10,000 in one month, 10,000 in another month, 10,000 in another month. So you are breaking off pieces of the lump sum, keeping an amount in cash, and then investing systematically over time and placing that money into the market where you are buying at different prices, either higher or low across, and smoothing that entry point out over time while keeping some of your money back in cash and investing over time. Now, that's dollar cost averaging because, you have a bucket of money that you're keeping back and then investing over time. What's dollar cost averaging number two? Well, dollar cost averaging number two is what folks are generally know about dollar cost averaging, particularly those if you are employed at a business and you receive a paycheck and you are investing every time that you receive a check, you are investing in the market, say using your 401k. So that's the dollar cost averaging folks are used to, right? To where they're like, well, I'm not keeping any cash back. I'm using dollar cost averaging, and I'm putting in over time, buying at different levels, high and low, wherever the market is over time, right? Well, the biggest difference between dollar cost averaging A and B, right, is that cash holdback, right? And when you're receiving money over time from your paycheck, right, you're using your money in order to pay your lifestyle amounts and your discretionary, your needs and wants and all that. Then you're placing your money into the market every 2 weeks, so to speak, or every month, right? That's actually lump sum investing, because what you're doing is that after you are, or hopefully before, right, you're taking your money that you have, right, from your paycheck, and you are meeting your lifestyle needs, right, current and future, and then you are placing that money into your retirement fund over time, right? Well, that's actually taking the lump sum that you have and placing it into the market, right? Because you're not holding any cash back. Now, lump sum investing is taking a lump sum amount and placing it all in at once. And when you are systematically investing, right, this is what the public is generally used to, is taking a lump sum of money at that paycheck and placing it into the market. So, for the premises of this show, all right, we're going to talk about lump sum investing as you receiving money, whether it be a windfall from a bonus or an inheritance or maybe a overpayment from your tax refund, all that, right? And placing into the market all at once. Okay. When we talk about dollar cost averaging, I'm going to show you the comparison between lump sum and dollar cost averaging, which is holding a cash amount back and then placing it into the market over time. All right. Which is different from the dollar cost averaging that I mentioned that everybody is used to when they're taking their immediate lump sum that's left over and placing it to the market systematically. All right. So that's the third one. We'll keep that to the side for right now. For right now, we're talking about the lump sum, right, versus the dollar cost averaging. And for a quick review, to give you a dollar amount attached to that, so you can keep it in your head, right? If you were to receive $250,000 right now, would you place that whole 250 in right now? Or would you take the 250 and hold, say, 200 back and place 50 in right now, and then 50 in after that, and then 50 in after that, and then 50 in after that, right? So these are the two differences in placing the dollar amounts on those two strategies. All right, so let's talk about the benefits of each, the drawbacks, and also the psychological aspects of dollar cost averaging and lump sum. Let's talk about the psychological aspects first. Behavioral finance deals with the way the mind thinks about investing, right? What are the general approaches of the mind that people have with their investment choices? Okay. And psychologically, dollar cost averaging tends to work well with the mind because if you have lump sum, right, and you place $250,000 in the market and experience an immediate drop in that amount because the market is underperforming, that doesn't tend to feel too well. It may have a feeling of regret that why did I do that? Or, why did the market treat me bad? Right. At the time of investing. And you experience what you call a little bit of sequence of return risk to where either when you place money into the market, you either get it, the market is doing immediately well or having a downturn at the point of investing. So when you're placing money into the market all at once, hopefully the market goes up and you minimize the regret factor. If the market is going down, it says, could I have timed that better? Nobody knows when the market is going to go up or down. Okay. So when you have dollar cost averaging and you get a lump sum save of 250, you say, how about I just put a toe in right now, put $50,000 in, and then the next month, and then the next month, and then the next month, which minimizes the effect of regret when you're investing in the market. That said, is that the best? Even though it minimizes the emotions, is that best mathematically, historically, over time? But here's the key thing as far as the way the math works with the dollar cost averaging. All right, we keep going back to the 250,000 and I say 50, 50, 50, but let's take it a step further and say you have 250,000 and you're investing 10, 10, 10, 10, 10, right? Over time. That means you are leaving back a large amount of money in cash. So while your small investments of 10, 10, 10 are being invested month over month, you still have a large amount of cash sitting and earning no return. This is the biggest issue with dollar cost averaging. And while it may help with the timing effect psychologically, right? It's like, okay, I'm placing small amounts of money in over time, and I am minimizing the risk of sequence of return, experience a negative one right off the bat. That said, mathematically, you have bits and pieces working in the market, but large amounts not. All right. And that large amount of cash is going to always bring down your overall return because you have a large amount of money not earning anything, and then small amounts of money earning something. All right. So that's the thing with dollar cost averaging, particularly with lump sums. Now, comparative to lump sum is when you receive money, you are immediately placing into the market, and that amount of money is at work immediately. And even if you were to experience a downturn in the market immediately, say so going back to that 250,000, and let's say there was a 20% drop immediately, right? Well, you still have a large amount of money in the market to where when the market recovers, okay, you're recovering off a larger amount of money than a smaller amount. Okay. So if you place $10,000 in over time, 10,000, 10,000, 10,000, 10,000. Well, let's say you did that over across 5 months. Well, that 5,000, well, that 5 months is $50,000. And if the market comes down off of $50,000 and then recovers, the recovery is off of a smaller amount comparative to where you had 250,000 and came back to say 230. Well, the recovery is off the 230 and not the reduced 50 amount, you see. And this is where the math of lump sum works beautifully. Now, not saying for each person, one is better than the other. However, over a long period of time, lump sum investing tends to have a better outcome than dollar cost averaging because of the large cash amount that's held back and not invested over time. Now, the two big behavioral finance aspects of investing, either lump sum or DCA, is one, that regret. All right, we spoke of that because folks simply don't want to have the luck of the draw, so to speak, and experience a downturn right after they invest. And another one is loss aversion. So people feel losses two times more than they feel gains. So not only regret, they just simply want to avoid losses, even though they may have a probability to having a gain. So there are behavioral finance academic studies behind loss aversion and regret minimization and mental accounting. But that loss aversion to where people feel loss two times more than they feel gain, right? That leads to avoidance, right? And this is dollar cost averaging. So even though you have a higher probability of having a long-term gain with lump sum investing, people want to avoid, right, the loss in the short term, the potential loss in the short term, and they feel that probability and they feel that potential of loss two times more than the probability of gain over time. Right. So it's in our mind, even though the math works out. And you know what? That's okay too, is to acknowledge and affirm what that fear is and talking it through, receiving information to see what's best for you. Now, at times, a dollar cost averaging just simply fits your position right now. And this moves us to a great segue into the next segment, which is when do each of these strategies work well for the situation that you are in? And when you're talking about dollar cost averaging, it can work well if your life right now calls for having cash on hand. Okay, so if the economy is not working so well, or you don't have income confidence, whether you're working for an employer or you have a thriving business, either way, where cash is king and queen, and you need to have cash on hand, and you do not have the capacity to experience an immediate loss. Okay. This is where dollar cost averaging can work for you. You can hold cash back and then invest little bits over time until you have more good footing under you to where you can then push the rest of the money in lump sum. Also, during high volatility markets could be another area of where dollar cost averaging psychologically can work, where you just have that overbearing sense of fear. It's like, you know what? This market is just so volatile right now. I'm going to wait a little bit. That said, even during volatile markets, the market tends to recover after those periods. And again, going back to what I said earlier, if you have a lump sum investment, even when that lump sum investment may experience some shock, all right, the recovery is still recovering on a larger amount of money, right? So there's give and take there. There's always space there to look into each individual's position, right, and then go into a strategy accordingly. Now, lump sum investing tends to win most of the time, even when there may be some choppy waters immediately or immediate loss with investment. All right, it for sure works in bull markets where the market is going up. Right, even in volatility times and market drawdowns, and it's going to work over time more than likely because of math, because you have more money at play. Right. There was a Vanguard study out there that shows a 60-40 portfolio in three different type of markets: sideways, bear markets where markets are going down, and bull markets where markets are going up, and comparing dollar cost average to lump sum and over rolling 10-year periods. And lump sum, three quarters of the time, tended to outperform a dollar cost averaging. Again, having that money in cash works well if that large cash position is going to be a drawback effect on the overall return over time. And here's the thing: when you have an investing strategy in place, right? You have a whole overall financial planning strategy in place to where you have cash allocations already, right? To help you smooth out emergencies, hiccups in the market, early retirement. You know, it's called the bucket strategy, using your cash. If you're cash flush and you have raised enough cash in order to address either one of those type of conditions, right? Then when you do get lump sums of money, either windfalls, inheritances, bonuses, or the money that's left over, that lump sum money that's left over with your check, then you have more confidence to place that money in the market immediately according to your financial plan. All right, so for a little bit more math as we close out this segment, let's go to the tape. If you were to invest $100,000 lump sum in the S&P in a 10-year period from 2009 to 2019, that money would have netted you around $415,000. If you have taken $10,000 and invested it year over year over that same period, you would have netted around $275,000. So with lump sum investing in this particular example, then you would have had a gain of about 135,000 more than you would have with dollar cost averaging. And as you can see, when you have $100,000 invested all at once, you have a larger amount at play and susceptible to receiving gains. And even if there's a drawback, right, the recovery is recovering on a larger amount comparative to the $10,000 over time, and you got 10,000 year one, 10,000 year two, you still have $80,000 in year two that you have it placed into the market, right? So this is the big difference between the two. All right, so let's wrap up with a clarification and an overview of what we learned about dollar cost averaging and lump sum. All right. Lump sum is when you are receiving money in your hand, all right, whether it be a windfall through inheritance, a bonus, okay, overpayments from your federal income taxes, okay. So you're receiving money in your hand. What do you do with it when it comes to lump sum or dollar cost averaging? Lump sum is placing that money into the market immediately, all of it, okay? And then dollar cost averaging is having that money in hand and peeling off some and investing it over time and holding some cash back. Those are the differences when you're having your windfall amounts in your hand, okay? Now, when you are having DCA, all right, which is commonly known as DCA at your place of employment or through your business, to where you're receiving your check either biweekly or monthly, all right, you are using your money in order to invest systematically over time. Now, that's the DCA that folks are used to, all right, which is actually lump sum because every time that you are receiving your check, you're using it for your lifestyle, okay, whatever that is. And then you have these lump sums left over that you're immediately placing into the market, all right, and buying at different levels over time. So to be clear, all right, keep hold of that DCA strategy when you're talking about receiving money from your paycheck. Okay. And when you're talking about windfalls, then that's when I want you to know the actual lump sum in DCA, which is all in lump sum, DCA, cashback, investment over time. All right. I hope that helped you. Every time that you are thinking about investing, I want you to uh, go back and look at your investment policy statement that you have worked with your professional and see what type of position you're in. What are your goals? What are your needs now? And how do you want your long-term investing to work? And then when you look at that, it will determine well, which one is best for you and why, and hopefully give you some empowerment to your actions. All right. That's what I got for you this segment. If you like what you hear, feel, and see on this show, please like and subscribe so you won't miss an episode. And until next time, we'll chop soon. Cheers.